Credit card debt in the United States is about to hit $1 trillion. That's insane, but it could be your financial opportunity. To figure out if this is a financial opportunity, you need to understand the following. 1. Why are Americans hopelessly addicted to credit cards? 2. Just how toxic is credit card debt? And 3. Why the heck would anybody want a credit card in the first place? After answering these questions, you'll need to examine who you are as a person to figure out how to benefit from this financial disaster. So what's driving America's credit card obsession? The sad fact is that most Americans are in a dire financial situation. Over 60% of Americans are living paycheck to paycheck. Over 80% of Americans have a credit card. Most of America is struggling to get by and has access to a very dangerous financial tool. But just how dangerous is credit card debt? Credit card debt is some of the most expensive debt there is, with an average interest rate of around 20%. That's genuinely horrifying. Let's compare that to the stock market. Historically, the stock market produces about 10% a year. Some years it's up 20%, other years it's down 30%, but historically, it's about 10%. That means that credit cards are charging twice what you can reasonably make as a normal investor. And it gets worse. Credit card debt shows its percentage rate as an annual percentage rate. Your bank account shows its interest rate as an annual percentage yield. What's the difference? Annual percentage yields factor in compound interest. Annual percentage rates do not. Credit card companies are underselling the true cost of credit card debt. Every single day, the credit card company is going to charge you a little bit of the overall interest. That interest will then start producing its own interest. Credit card debt takes compound interest and turns it into your worst nightmare. The other scary part about credit cards is that your credit score doesn't help you get a good interest rate. A credit score represents how likely you are to pay back any money you borrow. The higher your credit score, the less interest you pay to borrow money. Credit cards are the exception. Even credit cards that require a good credit score often come with an insanely high interest rate. For example, I use the Citi Double Cash card, which offers 2% flat cash back and has no annual fee. It's for people who have a good to excellent credit score. However, the estimated interest rate is roughly 19 to 29%. A better credit score means you get more rewards, but that horrifying interest rate is still there waiting for you to slip up. Despite all the horrors, people are still getting credit cards for 5 reasons: improving their credit score, rewards, as an emergency fund, ease of use, and fraud protection. But these reasons aren't as valid as people think they are. Let's start with ease of use and fraud protection. These aren't valid reasons because of debit cards. Credit cards and debit cards are equally easy to use. While in the past, credit cards would offer more fraud protection compared to debit cards, these days, debit card protections are impressive. Legally, if you report a suspicious transaction within 60 days, you'll have minimal to no losses. Additionally, banks don't want to lose your business, so they may go beyond the legal minimum. Which brings us to building your credit score. Credit cards are a great tool for raising your credit score because you show you can borrow money and pay it off. Credit cards can also destroy your credit score if you fall behind on your payments. But the bigger problem here is that credit scores are overrated. Most financially savvy people avoid borrowing money, so a credit score is rarely used. But there is one purchase where even intelligent people will need to borrow money: buying a home. But you don't need a credit score to do this. You can borrow from a mortgage lender who is willing to do manual underwriting. You'll need to provide documentation to the bank outlining your current financial position and proof of timely payment for your bills. If all goes well, you can get a mortgage for a house without needing a credit score. There are people who treat credit cards like an emergency fund. A genuine emergency fund is 3 to 6 months of your necessary spending set aside in a money market fund or a high-yield savings account. This solves your unexpected future financial emergencies. A credit card merely replaces one financial emergency with another financial emergency. This is not how emergency funds work. The last reason to get a credit card is the rewards. A benchmark for what a great rewards card looks like is 2% flat cash back. Getting cash back on every purchase is the most straightforward reward, and 2% is as high as you can go without adding in annual fees or complicated restrictions. This is a pitiful reward compared to the high interest rate that comes with the credit card. If you do a good job managing your card, you get 2% back. If you slip up, you pay 20%. If a casino offered those odds, they would go bankrupt because no one would play. So how do you profit from credit cards in the overall crisis? When it comes to getting a credit card, you need to figure out if you're going to be able to get that small reward, or will credit cards destroy your finances? If you are somebody who likes debt or is an impulsive spender, credit cards are designed to exploit you. With a non-stop barrage of advertising promising to make your life better if only you spend money, it's not surprising people make bad financial decisions. Over 23% of people cite high non-essential spending as why they're living paycheck to paycheck. If you believe you might carry a bounce on a credit card, just don't use a credit card. It's a lot better to be rich without a credit card than to stay poor by using one. Let's say you intend to pay off your credit card every month. The second question is whether you have an emergency fund. I have a credit card even though it's a low reward, high risk financial tool because if I must put a large payment on the card to deal with an emergency, my emergency fund will pay it off. There is no risk of me missing a payment. If you aren't prone to impulse shopping and you have an emergency fund, getting a credit card is fine. Be prepared to get rid of it if you ever start carrying a bounce. The moment you realize the credit card is using you instead of you using the credit card is the moment you throw it away. Destroying your financial future over a credit card isn't worth it, no matter how exciting 2% cashback is. Now, how do you profit off the whole crisis? The credit card debt crisis means that many people will not be able to purchase assets like stock and real estate during the next recession. Debt restricts people's cash flow, and you need cash flow to be able to buy assets. When the next recession hits, there will be two groups of people. The group drowning in credit card debt will struggle through the recession, unable to invest while the market is low. The other group will buy low, acquiring assets that produce passive income at a great price. Only one of these groups will find financial success long term. It's up to you to decide which group you will be in. If you want to learn more about how to take control of your finances, be sure to subscribe and check out my other videos. And remember, no matter what your situation is, there are always opportunities to improve your financial future.